Performing stock in the Dow for 2024 was down more than 30%, and that was after actually a significant comeback in the latter part of the year. Its worst year, by the way, since 2020. Here with her take on the path forward for the company is Jefferies Sheila Kahyaoglu. She joins us now and has a buy in the stock. I think your base case is 200, which when you wrote it, actually, the stock was a lot lower than it even is now, even down today. But you're looking for what? Revenues up 28% this year and 16% next year?
Yeah.
How confident are you in those numbers?
Sure. I mean, it rallied 30% since November 14th, once the strike ended. So what we're really looking for is free cash flow improvement. We're burning $14 billion in 2024. That's what we're expecting. $6 billion in 2025 and positive $8 billion in 26. And what's driving the rally is that improvement in production now that we're getting deliveries started. So we're going to get a 60% increase in deliveries next year off of MAX, which drives 50% of Boeing's free cash flow. So really, it's the MAX that's improving. But you also have two significant losses in 24 that continue in 25. One of them is the 777X. They're losing about $4 billion there and $3 billion in defense this year in 2025.
Yeah,
so
defense continues to be a real weak spot for the company.
I think it's the biggest risk that we can't ring fence because it's on 5 development programs that are still in different stages. So that's a watch item, as is the 777X. But hopefully the MAX gets going. And in 2025, we still have pretty depressed earnings on the MAX because you're so delayed from the strike. You're so delayed from Alaska this time last year that you're giving away the airplanes essentially for a very discounted price.
Yet you are expecting they're finally going to exit this really years-long downturn and just,
6 years.
Series of events that have been nothing but bad for the company.
Yeah, I think we've seen changes in management to potentially fix that. Right sizing of the workforce. Boeing's reducing 10% of its workforce. Its workforce is one of the most inflated, which is surprising. And maybe a culture change, more focus on safety. Not that it wasn't before, but clearly there's been lots of shortfalls, to say the least.
I was going to ask about the culture changes, because at the depths of the problems, and every time we had a new CEO come in, it was time to change the culture around the safety. What ultimately, you know better than we do, what went wrong in terms of prioritization and where the focus was?
What went right, I think, is the right question. Not much, right? We went from bidding on defense programs, essentially buying loss-making programs, taking on that risk to build a defense business. I think that was one of the most critical errors in 2019. And then in 2020, it was just speeding up production and just not taking the right steps. So we'll see where Boeing gets to. Ultimately, we think they get to about 40 a month on the MAX. They did about 18 in 24 on average. That includes the strike, so it's a bit deflated. But in the peak, they hit about 50, and that was it. So we'll see how quickly they could produce these aircraft. But everybody else outside of Boeing is essentially up to pre-pandemic levels.
Yeah, I was going to say, this entire multi-year struggle period for Boeing has happened while the macro, demand fundamentals for commercial aircraft has still remained strong. Is it still where it was pre-pandemic when it was like, as far as the eye can see, we're going to have this secular increase?
We're finally over that 2019 level where we've been historically behind. So we need about 1,500 to 2,000 aircraft annually. We're projecting from 2025 to 2027. We did 1,200 last year. So Boeing's shortfall is definitely impacting it. And that's why the aftermarket stocks really worked well last year. HEICO, FTAI, TransDigm, these stocks were up. GE up over 50% last year, up 100%. And so you saw that. And now you saw that pull back over the last 45 days into year end, given Boeing starting production and deliveries.
Free cash flow, obviously very important given that debt load. And the rating agencies are not unimportant for this company as well.
It seems like they're holding the line on investment grade, though. They're not looking to downgrade it. And now with a $24 billion cushion, I don't think that's a risk.
Okay. Sheila, thank you.